Welcome back to NSE Closing Bell on CNBC TV 18. Well, let's get our alpha manager for the day. Trideep Bhattacharya, who's the co-CIO of Equities at Edelweiss Mutual Fund, joins in now. Trideep, hi, good afternoon, and thanks for joining us. At long last, finally, the market correction that everyone was perhaps waiting for has come through. Of course, when it actually happens, there's a lot of fear in the system. But, you know, for the last 1.5 years, we haven't seen a correction, and now finally it's come about. Do you recommend buying into this dip, or has the time come to get a bit cautious?
So I think before I answer that question, and thanks for having me on the show, our running hypothesis on the market has been that we expected 2022 to be a tale of two halves. In the first half, we always thought that the market will have to adjust to the pace of normalization of interest rates, the Omicron issue, and also the stickiness of inflation. And we are exactly seeing, maybe the first half of the movie play out, in a similar way. However, in the second half, we expect the markets to kind of, react to the earnings direction, which will be as the earnings recovery unfolds. So we were always constructive on equities on 2022, but well prepared for volatility ahead. And in that context, in anticipation of a better second half, and if I may say so, next couple of years, I would suggest the weakness that we see, or the volatility that we see in equity markets in the first half, should be used as an opportunity to buy on dips, but in tranches spread over the first half of the year.
Okay. Well, point taken, Trideep, if it is playing according to that script that you just narrated. But are you using even the current dip to load on? And if yes, let's start with the sectors. What do you like in finance? Do you like finance at all, or have banks run up too much? And within banks and non-banks, what's the pecking order?
Yeah. So I think, thanks, Tata. Great question as always. I would say that we are actually over the medium term, 1 to 2 years, we are positive on the rebound on credit growth. And hence, in that context, we are positive on banks. We are positive on banks, particularly that are corporate facing, more than just the retail facing. And that makes us right-oriented as far as the valuations are concerned as well. Between banks and NBFCs, we are relatively more positive of banks versus that of NBFCs. And that's how most of our portfolios are stuck at the moment. And we are certainly in those cases where, we still have room to add. We are using the dips to kind of add on to the financial exposure that we have.
Trideep, the last time we chatted, you said you're reasonably cautious on a few sectors. If I got it correct, I think it would be consumer staples. You mentioned metals as well as utilities. That call's played out pretty well, but you still avoid them?
Thank you very much. You have a great memory. And yes, I think by and large, if you look at the impact of inflation and the fact that the way it has reflected in consumer staples results, so to speak, in the last quarter, that has by and large played out quite well for us. And as we speak, we continue to sort of remain underweight on those areas. Another area which we talked about that we've been underweight in the past has been basically the new age businesses. We sort of, by and large, thought that we will kind of, give it a bit of time to understand what they are. And fortunately, in the bloodbath that we've seen since the beginning of the year, we've managed to avoid that impact on our portfolios as well. So at the moment, we are in a good shape.
Okay, at the moment you're in a good shape. But what about investors who perhaps gotten a bit late, right? After seeing the opening tick on many of these stocks, whether it's Zomato, Paytm, Nykaa, there was a big bang listing for many of them. A lot of investors have gotten trapped at higher levels here. What is your recommendation to them? Keep the faith, stay the course, or move out of these platform companies?
So, as you know, I can't give stock recommendations here, but I'll put 2 or 3 things in perspective. I think, first of all, what we are seeing in India in the form of new age businesses is not new. We have seen that in Western world. Netflix is that a great example. But for every Netflix, Amazon, there are millions of Yahoos which have bitten the dust. So we have to be careful of that fact. Second, I think last couple of years have been really the boom time for some of these digital businesses, because all of us were stuck at home and the decisions were made on a digital world. As we go out, sooner or later over the next year or so, they will be facing the real life test as to whether, to what extent does the business momentum stacks up in such a scenario as well. As long as those two things are kind of, met, one should certainly, and considered in the valuations, one should certainly kind of, take a look at some of these stocks. We are kind of evaluating some of them. It is just that historically we have, thought that waiting for the better moment could be the right thing to do, and we continue to keep our eyes and ears open for that price.
Okay, all right, Trideep, what about metals? And basically the commodity play.
So I think basically our hypothesis at Edelweiss is something like this. That overall, we think at the moment, the commodity swing that we have seen over the last 6-9 months on the way up has been more driven by supply side challenges rather than demand pull, really. And hence, we think that, as things normalize over the next 6 to 9 months, that should ease off to a certain extent. That does not mean that inflation goes back to Corona era, but it will come back to certainly lower than where we are today. That's our running hypothesis on the commodities, and hence we think that the best days of commodity prices in terms of on the uptick are behind us. Also, obviously, this Russia-Ukraine crisis, till the time it is on, it will keep one of the key commodities, which is oil, on the boil, and that will probably not be positive for India. So hence, this may kind of go in swings and roundabouts. But I think we have moved on from taking direct exposure to commodities to more downstream or more converter kind of companies who benefit from demand, which is commodity led, but not from the commodity prices per se.
One sector that's getting hurt because of these commodity prices, Trideep, has been the automakers. We were just speaking to the management of Ashok Leyland. They as well were echoing that. And I'm looking at your portfolio where you have select CV names in there. Tata Motors Fund is mentioned. Ashok Leyland is in there as well. Your approach to the auto space, and from the auto pack, what are you particularly bullish on? Is it the CV space?
So basically, EV and CV rhymes well, isn't it? So basically, we think that overall autos as a whole, as a sector, is going through a bit of a disruption, whether it is driven by electric vehicles and or on the other side, two-wheelers or the price increases that they have seen over the last couple of years, added on by the commodity price increases. So in that context, we are, as you rightly said, we are selective in what we sort of choose. The Tata Motors represents our view on the EV side. They are the most aggressive on that side. We like their strategy, and we think there's room for it to go. While Ashok Leyland is mostly driven by the CV cycle. Now, by all means, these are historical positions, and by no means are these kind of recommendations for any of the investors or viewers overall. But that's the hypothesis based on what we have done in the past.
Okay, all right, we leave it at that. Thanks a lot for joining us, and have a great day and a great week. It hasn't started off well, but hopefully things will settle. For now, the market's still down and out. In fact, not wasting any time and correcting further. The Nifty is now down over 500 points, and it will close at the lowest point of trade, which is not a good thing for the bulls. Listed diagnostic companies, though, have been under a lot of